Hello and welcome to the Fat Tailed Thoughts podcast. My name's Stephen Dickens, your co-host, and I'm joined as always by Jared Klee. Hey Jared, welcome to the show.
Good morning, Stephen. How are you?
Yeah, not too bad, not too bad. For those of you who are new to the show, every week we cover the makings and workings of money, finance, crypto. This week we're going to cover probably another one of our sort of theme here on makings of money, good money, bad money. Jared, we're episode 24, which frankly is just amazing that you and I have managed to keep doing this for 24 episodes.
And still having fun.
Yeah.
Lots and lots more to come.
Yes, I think there's going to be some changes. Things are going to shift around. So if you're tracking our website, you're one of the 3 people that looks at our website.
No, we're getting picked. Stephen, the audience is picking up on there. We got good pickup on the podcast, good pickup on the letters. We'll start the website is falling shortly behind, but lots of new content coming down the pipes that will make its way onto there.
Yeah, so we'll put some links in there and share some of that in the show notes and tell people about what's going on, but some changes ahead, which I think are net positive of where we're going. So without further ado, great newsletter this week, talking about good and bad money, which I think is a fantastic topic. There's probably 400 things you didn't mention in the newsletter that gives us space for future pods and future letters. But I think really good breakdown for people who maybe aren't thinking about this. And maybe I'll frame the conversation here. Interesting, my little candy store in town runs a little card box where I can put money on the system, and my kids can go after school and they can spend money and then I go and top it up. A few weeks back, they'd gone crazy. I hadn't been in to top it up and I was running an overdraft at my local candy store. I think that's a fantastic jumping off point to maybe describe good and bad money, where this sits outside of the traditional banking system. So Jared, let's get the listeners and viewers here orientated. What are we talking about this week?
This is something a bit unusual, I think, for if you live in the U.S., if you live in the U.K., if you live in a place that has a strong banking system, strong regulations. We take almost for granted that if we put our money in a bank, if we put our money, say, we have, I jokingly started with Starbucks in the letter with the Starbucks rewards card. We could talk about PayPal or one of those systems that businesses use to process payments. We take for granted that when we put money in, when we go to take it back out, it'll still be there. That's frankly not the case throughout most of human history. It's not the case in the U.S. throughout most of history. It's certainly not the case as you go across most of the world. Most countries simply don't have the regulatory apparatus to turn what is stored money that you're effectively lending to somebody. I mean, that's what you're doing when you're depositing in a bank. It's recognized on their balance sheet appropriately as a liability. Same with PayPal. If you store money there or in your Venmo account or what have you, it's a liability. You are lending money to that party, and we take for granted that when we ask for it back, we'll get our money. That's pretty unusual. And as we'll see, that there's a lot of nuance here. As it turns out, a lot of things that we treat today as all good money, all being protected by strong regulations so that we have a reasonable assurance we'll get it back, it's not actually the case. Now, we haven't seen any problems blow up with this, but that doesn't mean there isn't room for a lot of improvement in the regulations. We'd rather get that right today, ahead of a crisis, than we would wait for a crisis to happen and then find out that we've got to bail out a bunch of companies, what have you.
And this is I started by a fun example of my local candy store that's probably 25 foot by 15 foot, and I go in there pretty regularly. My daughter works there. I'll go and put $50 on the company, on the sort of family account, on the proviso that I'll be able to get coffee and sweets and candies and stuff back in return at some point in the future.
We've got some type of Amber Alert or such here in New York.
Hopefully everything's okay. you draw the line from that total tiny little town store through to PayPal, through to the concept of good and bad money, and us putting it, and I'm using that to kind of start with the smallest of examples, through to I got $50 max exposure at any one time to my local candy store going bump. If you've got a couple of $100 on your Starbucks card, a couple of $1,000 in your PayPal account, you could have a significant amount of money with non-banking institutions that's not governed and regulated. So there's a sort of arc there, and I'm playing with the idea by talking about my local candy store, but I think it's illustrative without us talking about, could my local candy store go bump? Yes. Is it likely that PayPal goes bump? Probably not. Is there some line and some grey areas in between the two? Absolutely.
So it's an important distinction, and I had one of the readers actually wrote in and said, I disagree with the categorization of Starbucks as a bank, and I tend to, even though I wrote back and I said, actually I'm going to defend the use of that, even though I actually agree with you on almost every single point, and let me differentiate, and it actually flows through to the regulations. So when Starbucks today has about $2 billion in customer money sitting in the Starbucks Rewards program. For context, that would make them larger than about 3,000 banks in the U.S. I mean, it's an unbelievably large sum of money. But when you upload money to the Starbucks Rewards, with the exception of the fact that you can buy gift cards with it, there is no way to exit that system, meaning you can't spend your Starbucks Rewards at Costco. You can't turn them back into cash. What you're doing is you're pre-funding coffee and snack purchases. As a result, Starbucks is not regulated as what's called a money service business or as a bank. So PayPal's a money service business, a bank, Citi, JP Morgan, Chelsea Groton, take your pick. Reason being is that the regulator looks at that and goes, it's not money. You're not expecting to get it back in the form of money. You're just pre-funding it, and in return, you get a discount on every 10th coffee or whatever it is. If we go up the spectrum, and by the way, I use that headline because there are a whole bunch of headlines you'll see out there that kind of pop up on a monthly basis, quarterly basis as Starbucks release earnings, where it says Starbucks is the 120th largest bank in the U.S. or whatever. It's just not. By contrast, as we gotta go up the spectrum of where do people store money and how's it being handled, PayPal has somewhere in the order of $40 billion in customer money stored within PayPal. And they, by the way, own Venmo as well. But a huge sum of that money are businesses that run entirely on PayPal. So your online shopping, they take their payments, they receive it, they process it, they pay the employees out of there. Everything is stored and maintained in PayPal. PayPal is a money services business. Simply, and by the way, wonderful business. I think very, very highly of them. This is not an attack on them. It's the regulatory apparatus. PayPal is not subject to regulations that ensure that when you ask for your money back, there's actually money to give back. Rather, what you're relying on is PayPal's good word. And thankfully, they're a good company and they do good work. And they, from everything I can tell from a cursory look at their balance sheet and their approach, they're sound. But you are relying on PayPal. You're not relying on some type of meaningful oversight that ensures there's real money behind that. That differs from, again, going up the spectrum here, money market funds. So if you've got money stored in Fidelity or one of the big brokerages, oftentimes it'll be swept into a money market fund. That has a whole bunch of regulations on it that ensure the fund is always worth $1 when you try and get it back. And then at kind of top end of the spectrum are your bank deposits.
And you're talking here about stuff like FDIC insuring up to 250K's worth of the... So just for maybe listeners who haven't got this level of knowledge, if you put your money in Chase or Citi or Wells or one of the big banks, and if you put up to 250K into, for argument's sake, Citi, and then some cataclysmic event that none of us can foresee, Citi disappears, the government will give you your 250k back.
So I'm gonna correct you there. Yes, you are made whole. It's actually this is a weirdness. It's actually not a government fund.
And this was the interesting thing that I didn't realise by reading the newsletter. So I kind of on purpose said my misconception. But it was interesting, and you identified this. It's not coming from the government, although it's
it's effectively mandated by government. So the program exists by virtue of law regulation. But the program itself, FDIC insurance, is funded by the member banks. And if we go back last week or the week before, we talked about the futures market, how there's an insurance fund. If one of the market participants goes bankrupt, the other market participants effectively pay to bail them out based on an insurance fund. FDIC works the same way. Any bank that has FDIC insurance is levied a fee. That fee goes into the FDIC insurance bucket. Any bank that goes under and the depositors need to be made whole gets paid out of that bucket. So it's entirely industry funded. And by the way, that's not just a hey, until the government backstops us. Go back to 2008, 2009, when banks were going belly up. The FDIC never was backstopped officially by the government, never had to be bailed out. It was just, again, depositors were made whole based on the fees levied on the banks themselves. It's a really, really powerful system.
Yeah, and that was a revelation for me because I was under the impression it was government backstopped. We've gone down a rabbit hole here. Let's maybe go straight up to the top. Good and bad money. Because I think it's worthwhile spending some time sort of chatting there, talking about that, because I think we've kind of gone down into some examples. We've talked about FDIC, we've talked about the sort of series of different companies. Let's maybe just go straight back to the top and talk about good and bad money for a moment, because I think that's worthwhile.
So let's start with good money, because intuitively we think we know what it is. It's kind of when we get out further down the spectrum that stuff tends to break down. So we know what cash is. You got it in your pocket. You can spend it. Good money. I think there's some people who may disagree with how good the US dollar is right now, but I think I'll directionally let that comment ride. We're gonna leave that conversation to another day.
That's another whole podcast, I think.
If I go to the barber shop or go to the grocery store and I go to spend $1, they take it and they give me goods. So we'll treat that as good money. Further down the spectrum, what we would call M2 money supply. Bank deposits, money market funds. So you put your money in a savings account, in a checking account, or you swept into a money market fund. And money market funds are kind of the de facto place to go put your money if, say, you have above $250,000 per depositor, you can't get FDIC insurance. That's basically the best place to go stick it, shy of a savings account or a checking account, to make sure you're made whole. So businesses will sweep excess funds into money market funds. We treat those as money. We treat them as good money, to the point where we have a measure of how much money is out there, the money supply. We have monetary base, we have M2, etc. M2, which again includes the deposits and money market funds, is 3.5 times the size of the cash outstanding. So meaning, put the world of cash that's printed to the side, we have 3.5 times more of this other types of money than we do actual cash outstanding. And that's just a recognition of cash is great, but you have to carry it around. It's a pain. Someone can break in your house and steal it. This is a really good alternative. What makes that good money are regulations. And to be very clear here, it's not just FDIC insurance. If we look at the banking world, we have this prudential standard. We have this oversight. If banks are going to go under, if you say you went over the 250,000 FDIC insured amount, the banks can go to the central bank, that lender of last resort facility. In the event that the bank goes bankrupt, we have special default provisions where the depositors don't go through normal bankruptcy court. They basically get to cut to the front of the line, and they are made whole as quickly as possible. All of their funds are put to the side. There are a whole series of approaches that ensure that when things are going well, you have insurance. When the bank's not doing well, they have backup plans. When the backup plans fail, you're still going to be made whole very, very, very quickly. And on top of all of that, we've got these regulators saying you can't lend out at more than these rates. You can't take on this type of risk. They try and control the likelihood something bad will happen. That's the first set of regulations that help turn cash that you now lent to a bank, still keeping it as good money. You've got these protections in place to make sure you're whole.
And you didn't cover this in the letter, but I'm assuming a lot of that regulation goes back to the 1929 crash when banks were going bump. I mean, we don't have that in the common consciousness of the last few decades of banks going bump. Not saying it hasn't happened, but where it was a theme and a topic. And we've talked about sort of the banking regulations that came out in sort of 1934 and the 1930s. You know, we've talked about that, and I'm assuming, and you didn't cover it in the letter, but I'm assuming it's going back to that period that we have a lot of that good regulation and sort of backstops in place.
Precisely. It dates back to the 29 crash, and then subsequently we've made a whole series of updates. The original, and I hit on it, the original, how do we turn something into a bank as kind of we recognize it today, is the National Banking Act, which unbelievably is passed in the middle of the Civil War. They needed, quite literally, prior, and really fun subject for another time, prior to 1864 was the quote-unquote wildcat banking era. There was each state determined what a bank was for that state, which meant you had wildly variable regulations. There was no national dollar. Rather, each bank would issue its own banknotes. Well, if you're trying to fund a war, you kind of need money. So the National Banking Act put all the stuff we've done since then to ensure that banks don't go bankrupt, etc. The National Banking Act created a mechanism for the dollar to exist and to ensure it be reasonably stable. It's now gone through many iterations since then, but we had a problem. Even cash wasn't good money then, and we created a mechanism. As you're saying, then 70 years later or so, we said, okay, cash now seems reasonably good money. How do we now make the next iteration of that, the bank deposits, also good money? We get that subsequent set of regulations that turn banks that turn bank deposits into good money. The next one down the line is, well, money market funds. So money market funds are slightly different. It is a fund. There's a fund manager, and they take your cash and they go and invest it in stuff. We've set up money market funds with a whole bunch of regulations that basically ensure that the fund can't take on meaningful risk, meaning it's dramatically limited in what it's allowed to invest in. It's also, by the way, not allowed to take on other liabilities other than the depositor's fund. So it can't lend it out. It can invest in U.S. Treasuries is kind of the exception there. But for the most part, it can't lend it out. That ensures in terms of bankruptcy that if the money market fund ever did fail, well, there's no other lenders to fight over the funds. It's just we'll call it depositors for lack of a better term. You're first in line because you're the only one in line.
And the risk in that scenario would be that U.S. Treasuries wouldn't make the fund whole. But that's a percentage risk that's small enough that makes it good money. Is your kind of train of thought? It's
even more restrictive than that. There are requirements for the money market fund. I believe it's no more than 30% of the fund can be invested in securities longer than 60 days maturity.
So minimising that risk of there being price movement that means they can't make it whole effectively.
10% of it's got to be in cash or payables due within a day. I mean, this is so you ensure not only that the thing is stable, but that it's liquid, so that no matter when somebody shows up to go get their funds, there's always cash on hand, or at least rapidly will be cash on hand to return back to them. There are a bunch of other fun things like called the penny rounding rule that allows some fun stuff with the accounting. But again, we've taken a mechanism, we've dramatically reduced the risk it can take on. We've put the SEC in oversight to make sure that it follows rules and that it's reasonably stable. And we've ensured that in the event something goes wrong in bankruptcy, the depositors aren't fighting with the other creditors to get their money back. All in all, it's a pretty stable structure, and we treat it, if we put $1 in, we expect $1 back out.
So I think what we've talked about here is we've talked about the evolution of the base money. You did a good job in the newsletter of covering kind of how the US sorted that out with the Banking Act. We've talked about M2 and how that sort of extends the money supply as a measure, and we talk about money market funds and kind of bank deposits and the various other pieces. I think the arc for me, and we talked about, at the furthest point of the arc, me depositing $50 in my local candy store. I think there's a point, and where you were going in this is kind of legislation. We've done a good job on base money supply. We've done a good job on M2. Once we get past that point into other forms of money, there's a point, and the line goes from good to bad as it graduates. Talk to me about, for the next sort of 10 minutes or so, we'll have the rest of the conversation about that progression and some of the legislation that I think you were proposing of kind of approaches of what we could do in that space.
So the problem child that's emerged is money services businesses, and the one that's rapidly emerging is stablecoins. And the fact of the matter was, go back 10 years, this just wasn't a topic. And reason being is that there simply wasn't a meaning. Stablecoins didn't exist, didn't need to care about that. Money services businesses, I mean, they're as old as time. Western Union is a money services business. What they're doing is fundamentally they're involved money services business in moving cash from one place to another. Now, in the intermediary time, they're taking fees and so on, but they're aggregating funds and investing them, and they make money on the float and so on overnight before they actually go and deliver your money. Now, because they're in the business of moving money primarily, as opposed to holding money, there's never really a big concern about the riskiness of them. At any point in time, there's only a small amount of money outstanding, and if they went bankrupt overnight, anyone would lose simply what they were moving, not a lot. With it post 0809, as more money kind of exits the banking sector into the surrounding, but also critically, as we end up in the digital age and I want to, say, have an online store and my local bank that I've been using for 30 years doesn't even have a website yet, I have to find an alternative. And if that alternative is bundling the ability to make and take payments, pay my employees and the like, along with the ability to store funds, like what a PayPal does, it's simply a very convenient place for me to go store money. The problem is, and that's balloon. I mean, again, PayPal now has, closest makes no difference, $40 billion in customer funds on their books. But to be very clear, that doesn't, the regulations simply haven't kept up. The protections that I get at a bank don't exist at PayPal, and yet I store money there with the same expectations as if I stored it at a bank.
Well, and you talked about Starbucks being, bigger than 3,000 plus banks in the US. At $2 billion, where does 40 billion put you? And I'm putting you on the spot, but I'm assuming that puts you as a very big bank in the US. And
yeah, I can't. The answer, I know the number and I can't remember, but you're in the top handful percent of banks in the country. You're a super regional bank at that point.
Yeah.
It's a big size. And again, by the way, the reason I keep coming back to PayPal, they're the largest of the money services businesses by customer funds. Interestingly, just to get a sense of how weird money service MSB regulations are, Coinbase, the cryptocurrency exchange, is also a money services business. This is just kind of a catch-all regulation for, we're not sure what it is, but you're moving money across state lines, and you're a money services business. Just for fun, there's actually a carve-out for infrastructure that sells services into money services businesses. So the reason you and I can send Venmo to each other, but Verizon and Sprint and so on are not money services businesses, is because of this neat little carve-out that allows them to do that. Venmo is the money service business. Verizon is not. It's a weird infrastructure.
So the transport layer is not, Therefore, but the company facilitating the transport across the network.
Exactly, but this is, I bring that up just to give a sense, like, this wasn't a conversation 10 years ago.
Well,
we didn't have to think about whether Verizon was a money service business, and yet the regulations have had to update to
well, I'm having a whole conversation with my sister-in-law about, can we send money across a text message? Apple, you can, if you're both in the Apple ecosystem, we can send money across the Apple iMessage network, and it'll work at both ends from an Apple Pay perspective. So Apple and Facebook, same Facebook Messenger. Under the covers, you've got Apple, you've got Meta now. Underneath that, they own a money services business. That's the regulated thing. But then the network you're on is not regulated. The phone itself is not regulated. It's this carved off, like a PayPal thing off to the side. Well, and I think, and we're talking about some examples here, and the companies we're mentioning are just easy ones to illustrate because most...
PayPal's the biggest.
Yeah, people will know who PayPal are. They will probably have a PayPal account. They'll have seen it. But it's interesting, we're recording this on April 12th. We're late. Stuff has happened. But it's interesting, in the past week, Fast has gone bump. Covered fantastically on the All In podcast, if you want to understand what's happened there. But that's a payments startup, and I'm not going to dunk on those guys because they've been dunked on enough in the last week. But there was money probably in transit. Were they regulated? I'm not speculating that anything's gone wrong or saying that it has. But I think it's illustrative of the fact money was moving from point A to point B across the Fast system. What's the risk? The point I'm drawing, when we're trying to draw some illustrative points, my local candy store, Fast, PayPal, Apple, there's a percentage chance of risk at all points on that distribution curve, but this is a unevolved regulatory framework for lots of different businesses. Was the point of the letter, I think.
Yeah, I think I think it's helpful here to put PayPal in context, and let's just take and by the way, again, I want to repeat because I do think very highly of them, and I want to be clear. Even that aside, that the takeaway here is PayPal, by all accounts, seems to be a good business. To the best of my knowledge, they've met every demand from a customer to return funds, etc. This is not about PayPal. This is about the regulations. Using them as an example because of how large they are, but this is very helpful example here. So money services businesses, unlike banks, are regulated purely on a state-by-state basis. There's a trivial, hey, you have to register with us with FinCEN at the federal level, but there is no meaningful oversight. There is no meaningful capital requirements. It's pushed down to the state level. What that means is that, like in kind of the 1850s banking era, you have states competing, lowering their regulatory standards, trying to earn the business of the money services businesses, hey, come domicile in our state. Also, because of how old money services businesses are, a lot of the state regulations were written for a time where you had physical branches. So, for instance, you will find that minimum net worth requirements or restrictions on they're based on how many physical branches do you have in the state. It's not a meaningful metric today. So, regulations at the state level for PayPal's and Coinbase and the like generally fall into three buckets here. Bucket one is minimum net worth. It's like just to keep cash on hand, retained earnings on hand in case something goes bad. Secondly, what's called surety bonds or the like. It's if something bad happens, this is a fully set aside bucket of money that you can go after to make you whole. Third is restricting what the money service business can invest in. Like, hey, you can't go lever up 10 times or day trade crypto or whatever it is. It's hey, you can only invest in certain things. So we know you're not taking on too much risk. So notably absent from that list, by the way, the bankruptcy stuff. Like if you go bankrupt, what happens to the customers? Well, the answer is basically none of the states really have rules about it. So we're not even talking about it, even though we should be.
And the interesting thing from reading this part of the letter was the ridiculously tiny amounts of money that what you'd think would be huge businesses would need to put to one side. And again, we're not saying that PayPal or Coinbase or any of these businesses are going to go bump. They're fantastically ran organisations, publicly traded, really good governance and oversight. But I think there's some interesting amounts in the letter.
So this is, again, $40 billion in customer funds. PayPal could meet the net worth requirement with $3 million, not billion, $3 million in retained earnings and equity. Your surety bond or similar requirement. Most states do actually have that, which is helpful. PayPal, and importantly, on a state-by-state basis, each state has its own requirements. 42 million. So again, 40 billion in customer outstanding. If they went bankrupt, the set-aside bucket of funds is 42 million. Reminder that's state by state, so depending on what state you move in, you don't get a claim on the whole thing, just on one piece of that. Permissible investments, what can PayPal go and invest in itself? 12 states have no restrictions whatsoever, just do whatever you want. 31 states, among the things you're allowed to invest in is your own subsidiaries' accounts receivables. That's literally just lending money to yourself.
So the net takeaway is, and again, PayPal, purely for illustrative purposes, 40 billion outstanding, backstopping that through regulations, 45 million.
And if you, depending on what state you live in, it's not all. You can't go after that whole 45. I don't want to overstate this.
We don't overstate that 45 million people, because you may be in one of the 12 states that doesn't have that backstop, and therefore you got no call on that. I'm assuming and New York is probably one of the better regulated.
New York and California tend to be more aggressive.
So I think the illustration here is, and as I start to bring this home, I'm going to set you up. This is the systemic risk in the system if we have a big failure of one of these organisations. What would unravel? And there's from my local candy store through Fast, through to PayPal and Apple, there's points on that scale. Yes, we're not saying PayPal could unravel, and there's a very different risk of that happening than my local candy store. But this is a line on a curve. Where's that risk? And the regulations haven't caught up.
And importantly, we don't even the two steps of this. One is making sure that the money is sound and that it's appropriate protections. And you have, in the case of bankruptcy, what happens. But we're not even set up for oversight here. In the banking world, we have a prudential standard. We have layers and layers and layers of oversight. Critically, we do it at the national level so that somebody can take a look across the entire system and say, you're not, even though isolated it looks okay, I'm starting to see things emerge at the system level, a systemic risk. We don't have any of that in the money services business world. So as a result, we can see the balance sheets. We understand that there is risk of this money, but we really don't have a sense of what's going on and where the risks are being taken, and what, with the exception of large public and well-run companies like PayPal, we don't really have a sense on the many smaller players what's actually going on. That, if we look at the news, has made a lot of headlines with stablecoin issuers. Stablecoins are much smaller, but fundamentally, we're talking a very similar set of issues here, where you have an issuer saying, here's a digital representation of a dollar, and when you come back, I promise you there's a dollar that I've stored somewhere that I'll give you. And they're brilliant organizations like Paxos, who's a qualified custodian, and they're now a trust, national trust charter, which is licensed by the OCC, a banking regulator, that ensures they meet a whole bunch of standards. They're really, really good organization. But we don't have any real regulations on the books of who can issue stable coins today. Paxos is a well-run, trusted company, but Joe Schmo's corner shop could go issue a stable coin today, and there's not a whole lot that restricts the shop from doing so, and you don't know how Joe Schmo actually runs their show.
And we've spent 35 minutes here, and we've not talked about Tether. We've not really double-clicked on stable coins. So I think this is the prelude to what's going to be a bigger thread from us. But I think summarise us up here. What are the challenges? What should we be aware of? And I'm going to give you 30 seconds, which I know you won't keep to.
So I'm hopeful that the stablecoin conversation, because it's much smaller, but it's growing. Circle, put Tether to the side, and the shenanigans they get up to. Circle's issued about $50 billion worth of dollar-backed stablecoins. Paxos has issued another 10-15 billion or so. They are well-run organizations. But because they're growing so rapidly, it's forced a conversation at Congress of what the hell's going on. Are we taking out risk? So on and so forth. I am probably too hopeful, but nonetheless hopeful that the awareness that you have, the growth of businesses like stablecoins, like money services businesses that are taking on what customers think are customer deposit accounts, similar to a bank or a money fund, but in fact don't have the regulatory protections behind them to ensure that they're up to the same good money standard. I'm hopeful that this rapid growth has kind of raised awareness to a point where we start to see a push for meaningful new regulation that brings them into a good money standard. And we can, in 5 years' time or 10 years' time, wake up and say, yes, money stored at one of these institutions I'm comfortable with because I know it's good money because it has the regulatory protections it should, given the way it's being treated by customers.
I think that's a fantastic way to summarise. You've been listening to the Fat Tail Thoughts podcast, where every week we cover the workings of money, markets, crypto and fintech. Jared and I will be with you next week. If you like what you've heard today, click and subscribe and click for notifications. We'll see you next time. Thank you very much for listening.